Good morning, everybody. I want to introduce Rajan Chopra, who is our market trading coach. Rajan's going to be joining us weekly to discuss the mental side of trading, among other topics. And so, welcome, Rajan.
Michael, thank you for the opportunity. I'm really excited about being on the Opportunistic Trader team and help traders with the mental side of coaching traders to improve their performance.
Yeah, well, thanks for joining us. We're looking forward to having you. You've got a lot of great information, and helping traders on the mental side is really important. A lot of people, a lot of big hedge funds and traders pay for psychologists and mental, to help with the mental side, and so it's really important. And I think it adds a lot of value to our traders. But before you get into your topic for today, I thought it would be helpful if you could maybe give everybody a little bit of background about who you are and what you've done.
Sure. Michael, I spent about 30 years on Wall Street trading interest rate derivatives. I was fortunate enough back in the early 80s, in the very early days, to get involved with the development of interest rate swaps and other over-the-counter interest rate derivative products. I was the chief dealer at the Chase Manhattan Bank on the swap desk. Then a few years later, I became the chief prop trader at Chemical Bank, and then worked for a couple of hedge funds, and then went back to Chemical. Chemical merged with Chase, and Chase merged with JP Morgan. So I've had a long track record and career trading interest rate derivatives and also helping develop some of the interest rate derivative products that are in existence today, like swaps, caps, floors, amortizing swaps, basis swaps, all facets of the fixed income market. So 30 years, I like to say, it's sufficient time to have observed as to what works, what doesn't work, especially on the prop trading side or where we're putting principal at risk. So a few years back, I reinvented myself and became a coach. And now I coach traders, entrepreneurs, and senior executives at various corporations on the mental side of trading, risk management, strategy, leadership, amongst others. Trading is part of my DNA. It's core to my practice, and I hope I can share some insights that would benefit your clients and your community out here at Opportunistic Trader.
Yeah, absolutely. You've been around for a long time. That's great, and you've worked at a lot of different big institutions, and so that's definitely something we'll want to touch on another time as well. But I know you wanted to speak to everybody today about edge and trading edge, and so I'm interested to hear what you have to say on that.
Sure.
Rajan,
Yeah,
also sorry to interrupt. If you could just also come a little closer to the mic, that would be great.
yeah. Is this better?
Yeah, it's better.
All right. This is here, Opportunistic Trader. I thought long and hard about this series of webinars, and I thought we'd begin
You have
with
four appointments in
some.
the next 11 hours at 10 a.m.
Hold on, I'm sorry. To begin with some foundational concepts about how to become a successful trader. I mean, to be a professional trader, we are essentially in a business. And like any other business, we're looking for returns and profitability that is consistent and sustainable. It's not like, a trader has a hunch and you bet a bunch, you're right, you make a lot of money, you're wrong, you lose a lot of money. So one of the foundational principles, the concepts behind becoming a successful trader is what I call knowing your edge. What is our edge? The concept of edge is trading is by definition short-term in nature. It's not investing. It's very distinct from investing. And as such, trading is a zero-sum game. One trader's gain is another trader's loss, or less than a zero-sum game if one accounts transaction costs. So how does a trader systematically and consistently beat the market? They've got to have some edge, some skill that helps them either predict market movements, price movements correctly, and also they have some distinct skill that differentiates them from the rest in terms of risk management. How do they structure their trade? How do they take risks? How do they manage those positions? How do they go about the whole ball of wax? What's the process? So I throw that question out. What is your edge? Now, in my observations, every trader feels they have an edge. They have some insight into some superior technical analysis or some superior research that they do, or they have some kind of, if they're on a flow desk, that they have some flows that they see where the capital's moving, or some other edge. But really, we need to do some hard, deep thinking and ask, do we really have an edge? Or do we just think we have an edge? I'll take a pause out here and throw it out for questions.
I'm sorry, I missed that. Were you?
I said I'll just pause for a second and see if there are any questions so far. People, if any of the participants wants to know about.
No, I think if, continuing, similar to what you're discussing with edge, I agree. A lot of traders, that's what they're looking for, some sort of edge. What is that edge? People, whether it be at different moving averages versus what other people are looking at correlations, things of that nature. But these days, computer models are also actively looking at all that and trying to create their own edge as well. And so it's, constantly battling that.
Exactly. So to your point, most market participants are looking at the same data. They're using similar tools to predict price movements. They are using similar risk management tools. They're algorithms. They're trend followers. They're momentum followers in every different asset class. But how does one know if one truly has an edge? How does one consistently beat the market? The answer is not that simple. We have to dig deep into our own processes and come to some kind of a determination to what is it that makes us different? Where do we have an edge? If we don't know, then we probably don't have an edge, and perhaps we shouldn't be trading those markets. But if we do, then we need to support it with data. We need to gather data and look at our own performance and see how our system or our thinking or our process has fared in the past, how it's doing now, how we can make some adjustments and corrections so that we consistently maintain that edge that earns us a consistent and sustainable returns in the market.
So if somebody comes to you and says, how do I develop an edge? What do you tell them?
Great question, Michael. Great question. It varies from trader to trader and shop to shop. And the process begins by asking a lot of questions, digging deep and say, hey, why are you trading? Why do you want to trade? And the answer usually is, hey, it's a business that I'm building, or I'm here to make money. Okay. So how do we make money? If you write on price movements and market calls, how often are you right? And when you write, how much do you make? And when you're wrong, how much do you lose? Risk management. What is the process? How do you go about determining what to trade, when to trade? How do you position size? How do you manage your risk? How do you put in stop losses? Where do you know you're right? Where do you know you're wrong? How do you add to positions or detract from positions? It's a complex process, but each individual case is different. I'll use a poker analogy like some movie star once said, if you're sitting at a poker table and you don't know who the sucker is, chances are it's you. So if we don't know our edge, we probably don't have one. So how do we go about developing one? It's especially in today's markets where machines are replacing human beings. Do we have a system? Do we have a model? Do we have something that gives us some edge over the rest of the market participants? Is it unique to us, or is it being implemented and used by every other market participant? For example, when you look at technical analysis, 10 people can look at the same chart and come around to 10 different conclusions. How good is our skill at predicting price movements? How good are our trade structures? How do we structure our risk positions? There's a smart way of taking risk, and there's a not so smart way of taking risk. Do we have, can we somehow build in an asymmetric risk profile into our portfolio, where asymmetric risk profiles means that if we're right, we're going to make multiples of what we're risking, and if we're wrong, we're only going to lose a fraction of what we intend to make. That's a strong risk management tool, a strong edge that we can incorporate into our trading process. How disciplined are we with our stop losses?
Right.
Are we disciplined all of the time or just some of the time? When do we go totally on tilt where, we lose emotional control over our positions in the face of some very significant adverse price movement where we're losing money? What do we do? Do we stay disciplined, or do we double up on our loss positions? Do we lose more money? What do we do? It's about control. It's about discipline. It's about knowing how we can consistently stick to our process, whatever that process may be.
So what do you tell somebody who comes to you and says, regarding your topic of edge, for the past 5 years, I've been very successful. I've been trading this or that. This has been my edge, whether it be a technical or a correlation or something like that, but my edge is no longer working. What should I do, Rajan?
If the edge is no longer working, the first thing I would recommend is take a break from trading. And unemotionally try to figure out what is not working and why it's not working. I'll share an example with you. I was a very big trader and very successful. But those were different market times, those were different market conditions. Today, I don't have that edge anymore. I'm a dinosaur. Algorithms and machines have replaced what I used to do very well. I don't have a hope in hell to be successful in the markets today if I deployed the same strategies that I did 20 years ago. So I recognize I don't have that edge. Another edge that I had was I had a big flow desk behind me. I could see some of the biggest flows in the market. Who's in the pipeline to buy or who's in the pipeline to sell, and you could somehow piggyback those flows and make a good living out of it. We don't have that. I don't have that edge anymore. So for somebody who's been successful for 5 years, I would suggest use data. Look at your past performance data and see how, it's really essential to have data verify our actions. Data does not lie. The penal reports don't lie. We need to examine data, past performance, current performance, and predicted future performance. How have we done so far? Where have we failed? What's not working anymore? And see if somehow we can recapture or restructure or modify where we once had an edge. If we can't, then we need to look at something else.
Yeah, that makes sense. I mean, the market's ever changing, and like you mentioned, 30 years ago, the way people were trading in the pits, you were able to see huge order flow and maybe get in front of that or participating in that, things like that. And so a lot of people made money in that area. There's been a lot of transformations every year, and especially with technology and things like that, the market's ever changing. And so one key area that I'm hearing a lot of discretionary traders constantly discussing the markets about is, computers, technology, algorithms, anything you might be looking at, they are looking at, but maybe looking at faster. There's always opportunity, but you have to think of, look at the market a bit differently.
Absolutely. I'll give you a real world example of a hedge fund that I've been coaching recently. It's a relatively small and new hedge fund. They got about 100 million under management. And they have a strategy on consumer equities, which is purely AI based, artificial intelligence. So far, their data has proven that they have an edge. And this is what they do. They got a couple of data scientists. They've got these great computer models. What they do is they go out and mine big data, social media data, on, let's say, 100 different consumer companies. And through mining this data, they compare, let's say, company XYZ. This is the activity we're seeing in social media. This is what our data points are telling us, that they're selling so many widgets, so many more widgets than what the market is consensus. They look at the market consensus. They look at what the data is telling them. If the gap is really big, they would buy or sell that stock in front of earnings releases. Regardless of the price of the stock, they don't even pay any attention to what the price of the stock is. Their strategy is simply to compare what the market consensus is on earnings and what their data mining is telling them. And their track record for the last 18 months is phenomenal. It's in the high double digits, their returns. But they found a niche, they found an edge. As long as that model works, and the other market participants haven't caught on to it, these guys are consistently making money.
So
tomorrow, yeah, go ahead.
No, sorry to interrupt. You can keep going.
No, tomorrow it may or may not work, but today it is. So they have an edge.
No, absolutely, and that makes a lot of sense. And so it's interesting if you can continue on with this point of what do you talk to them about on when you speak with them about the way they analyze the markets and just kind of helping them frame, I guess, confirmation on their thoughts, or when they're not trading well. What do you talk to them about?
I've been talking to them more about the other side of the model, that is risk management. That is, okay, so far your models are working and you guys are making money. But let's put some more focus on the risk management side, that is position sizing. What if suddenly the models break down that don't work? How much do you stand to lose? How can we incorporate some asymmetric risk in your positional profiles? So it's like, it's like saying, you guys have had tremendous success and you continue to have success every month, but let's put a buffer underneath so that you're not blindsided tomorrow, all of a sudden, your model doesn't work anymore. So that is creating another layer of edge on the risk management side. That's what I'm helping them.
Yeah, that makes sense. So also, though, it sounds like they're more on the systematic side. So how are you helping them? I guess you're obviously not programming anything from that side. You're just really helping them with the risk management side of the business, you would say more?
Yes. It's like, say, for example, what percentage of your total capital are you allocating to any particular trade? Right?
Right, and just help them focus on the longer term. Just continue to cut your losses smaller.
It's risk allocations and also hedging. That okay, you have a sizable position on this one stock for earnings. What if your models turn out to be wrong this morning? How much do you stand to lose? How does it impact your monthly performance, your year-to-date performance, and your overall performance? What risk management tools are available to you to mitigate that risk if portfolio manager so chooses to do so? Okay, we've done very well. I have this sizable position going to earnings. Maybe I'll buy some put options, a small amount, just in case the models don't work this time. It's about risk management.
Yeah, that makes sense. So how do you talk to clients about volatility? When volatility picks up, people's anxiety picks up, things of that nature. They make irrational decisions. But oftentimes, when there's higher volatility, there's actually greater opportunity. How do you talk to them about that?
Now, Michael, great question. Great question. Incorporating volatility is part of the whole process of how we approach the markets, how we approach trading. It's not unique. It's not day-to-day changes. It's the whole process. A lot of thinking and planning goes in before a position is initiated, taking into account where the markets are, where the market levels are, what the price levels are, what are some of the recent performances, historical performances, what does the underlying asset do on earnings releases, or how much does it move typically? Where are we in the macro environment? All right. Are we in a very low vol environment? Maybe if premium is that cheap, maybe it pays to have some hedges on. Is it a very high vol environment? Maybe it's time not to hedge at all. But it's a process. It's a process in a holistic sense. Volatility cannot be looked at in isolation. It's how we approach the markets, how we approach each trade, how we approach, that is what I call having an edge, a comprehensive set of tools, a comprehensive approach to how we think about trading.
Yeah, that makes a lot of sense.
Did that help? Is this helpful?
Yeah, of course. I mean, right now we're in an environment where obviously early in the year we had volatility pick up, and traders volatility has decreased over the past few months dramatically. Today we happen to have a bit of a higher volatility day. People are looking for larger moves, and typically that's when at times people. It's a more dangerous time. It's a more opportunistic time, but sometimes traders, get themselves into trouble with the volatility. And that's typically when it's more important to speak to somebody like yourself and get some insight.
It really is. Let's call it a larger caption. How we view the entire process of trading markets. What is our process? Each trader has to know what their edge is, how they differentiate themselves from other participants in the market. It is a zero-sum game. How do they manage risk? Managing risk is part of the edge. I mean, take for example, the last couple of days, media has been focused on Tesla. All right. 3 days ago, the CEO announces we're going private. It has a very large short position, so of course, shorts are scrambling to cover, and the stock goes up 12% in one day. For some traders, who have the insights into the LBO processes and what works and what doesn't work, it was probably a very good opportunity for them to short the stock at $380 a share. Because in their minds, they probably think this is the most un-LBOable stock ever. 90 times leverage. They don't have any cash flow. They'll never be taken private. You cannot do an LBO. So they probably found an opportunity to short the stock. There are others who think that, hey, this guy will take it private. Maybe the stock does go to 420. So they're both sides of the equation, but each side probably thinks that they have an edge. They have superior knowledge or superior information, and here's an opportunity to either make money or lose money. But again, if one has a platform or a process that is solid, we know what we're doing, we know what we're good at, we know what we're not good at, sometimes the market gives us opportunities. And we are well positioned to take advantage of those opportunities because we have a basic infrastructure in place, a mental infrastructure, a discipline in place.
Sure. So touching on what you just mentioned before, you mentioned the word process. If there's a beginner trader, we have a number of beginner traders on the platform that are just getting started out. What would you tell them about how to implement a process, and what would you tell them on that, about a process?
Great question. This will probably take some time and be a whole different webinar. But in summary, it all begins with that beginner trader's mindset. And the mindset is, how do you live your life? Before you even show up on the trading desk in the morning, have you slept well? Have you been to the gym? Have you worked out? Are you in a good emotional state? Are you in a good physical state? Are you well rested? Those are some of the basic, essential starting ingredients. When you get to your desk, what do you do? When you're looking at a trading opportunity, how do you go about evaluating that opportunity? Is it one of those things, hey, prices are moving, markets are moving, and suddenly you see something and you just jump on board and buy a few hundred shares of a stock, or buy a future or sell a future because you're getting carried away by momentum? Or are you disciplined enough where you're doing your research, you're doing your evaluation, say, okay, here's an opportunity trade that I see. This is my research or my insight into why this price should be at a certain place at a certain specified time in the future. How do I best intelligently take this risk while I minimize my downside? All right? And then he goes about thinking and planning and processing, what is the best trade structure? Do I just buy it outright, sell it outright? Or do I structure it with options? Or do I do a spread? Or how do I get the biggest bang for my buck? You run those scenarios. Again, it's data, it's numbers, it's math. Run those scenarios. Find the optimal trade structure. Now you're looking at the timing of it. When do you best enter the market with that trade? Is it now? Do you have the patience to wait? Sometimes patience is a great thing. Or so that's part of the planning process. And once you've initiated the position, you got to position size it too. What's the size of the position? If you can't sleep at night and you worry about your position, chances are it's too big. Right?
Absolutely.
So once you determine the structure, you determine the position size, you determine the timing, you initiate the trade. But even before you initiate the trade, you already thought about managing the risk of the ongoing open position. What happens if all of a sudden you have an adverse price movement against you, a significant movement? You have a stop loss? Or is it an opportunity to add to the position? Where are you going to take your profits? Are you going to be disciplined about it, or are you going to get greedy? All of this has to be mapped out long before a position is initiated. And one has to be disciplined at all times, not only sometimes when it's convenient. That is what I mean by an investment process.
Yeah. You know,
That's
you mentioned
consistent approach, yeah.
you mentioned early on it's important to be well rested. I don't know anybody who's well rested,
Well,
especially with trading week and volatility and families and things of that nature. Maybe on the weekend to rest a little bit, but somebody else also mentioned in a different webinar. I'm trying to remember who. Eating healthy and being well rested. I don't know. A lot of traders rest on the weekend a little bit, but during the week it's 24/7.
I know it's 24/7, but that is why, it's essential to find and be disciplined about carving the time to be well rested, because yes, you want to be in a good, solid, sharp thinking state of mind.
Absolutely.
You cannot be if you're exhausted or stressed or distracted by a whole lot of other things. I mean, look at some of the real successful traders out there, the big names. I mean, they meditate during the day. They take breaks. They take naps. They go to the gym. They work out. They put that into the daily discipline. Doesn't matter if the market's blowing up or the market's going gangbusters. They stick to the routines, because it's not about just winning or losing. It's not just about a one trade. We're talking about consistency and sustainability for the long haul. If you view this as a business, like any other business, then hopefully we want to be in this for a long time. How do we attain that consistency and that sustainability? We have to have these basic elements in place.
Yeah, well, that makes a lot of sense what you were just saying, especially about routine. You hear about a lot of people, just keeping a consistent routine when you wake up, what you do, whether it be replying to emails, workout, things of that nature. And I guess similar with the trading mentality of, okay, news comes out, I place the trade, I have a stop in mind, I'm positioning, a certain amount, and just staying consistent with that routine, and then, reacting to what the market does at that point.
I'll share an example with you. There was a very, very good trader I respected a lot way back. He used to trade long bonds. And his edge, or his methodology for trading long bonds was, this is back in the 80s, early 90s. He was very prominent and well wired into all the Wall Street investment banks, hedge funds, and banks. And he talked to all his buddies on every shop. Now he's already formulating a market view. He's talking to all his buddies and figuring out how people are positioned, long, short, spread or what. And once he'd done his research, he came to a decision whether he was going to go long or short the long bonds. And he would initiate a very large position. Once he'd done initiating the position, he'd leave the trading floor for 3 or 5 days. He'd just go and play golf. He didn't want to be called. He didn't want to look at screen. He didn't want to hear about what the markets were doing. Because he knew his weakness was that if he watched the screen and the prices, he may be tempted to either terminate his position if prices were going against him, or be too early in taking profits. So he removed himself. That was his discipline. He removed himself from the scene. He'll come back 5 days later and unwind his position, usually for a very substantial profit. And he did this for years and years and years. The system worked for him. That was his process. Whatever it is, it worked for him. And he was good at it. Now, just a little side story, but we all have a way that we can develop a process that is right for us. Each trader has their own individual mental makeup, own individual level of risk aversion or risk tolerance or risk embracing philosophies. So we all need to customize a process that works well for each one of us.
Sure. And, following up on what you just mentioned, when somebody is maybe in a bit of a losing streak, they're following their process, they're following their edge, but, certain times the market just isn't adding up. What do you tell them about, don't trade for an hour, don't trade for a day, a week? Like, what do you tell them in terms of to clear their mind?
Michael, I would never put a time frame with an hour, a day, a week. But what is essential is you stop trading and you evaluate and regroup. And whenever you're ready to come back into the market, you come back into the market. So the first thing to do is slam the brakes so that you don't hit a wall, don't do any further damage to yourself. And then figure out what went wrong, what didn't work. And, we basically need time to regroup. We need to regroup our emotions. We need to regroup our confidence. We need to evaluate what happened. Why were those mistakes made? Or what went wrong? So no particular time frame here. It's, it depends on the individual, but whatever time it takes for them to feel they're whole again before they re-enter the market.
Yeah, that makes sense. Mark Fisher, who's actually coming on today at 12, very successful energy trader, has been around the markets for over 40 years. He made a point. He was on with us a few days ago, and he actually wanted me to ask you something. He said, going along with what you're saying, it's really important to be mentally there, mentally prepared for the market, and whether, the day before you have a fight at home with your wife, or, he said, the cable guy doesn't show up, or the roofer, you're having an issue with the roofer, or something like that, you got to be mentally there and prepared, and if not, don't trade. But he was saying a lot of people have the mentality of they want to sell something. When things aren't going well, I want to sell short the S&P, or I want to sell oil, or I want to sell copper. And he wanted me to ask you, why is it that people always want to sell something? They don't, when they're angry, they don't want to buy something.
It's actually Mark's an astute trader. That's a keen and a good observation. Tell you the truth, I don't have an informed answer to it, but I would say this. It is almost like a natural human tendency. We somehow emotionally find it, some of it, easier to sell than to buy. Because somehow at the back of our minds, emotionally, buying is equal to cash going out. Selling is equal to cash coming in. Somehow, I could be wrong, but it's a great observation that Mark's made. But and I think he's probably right. But there's no rational justification for either, because capital is being put to risk, whether you're long or whether you're short. But somehow sell something. To open a new position, to open a short position is one thing, but selling an existing position is basically liquidating and minimizing risk.
I also had a bit of a theory on it as well, and maybe you can elaborate on it. Typically, the public in general is long equities and is long things, and so oftentimes people look for opportunities to look smarter than the average person, or do something different. Whether not necessarily smarter, but also hedge funds are paid to outperform, and so one possible way to outperform is to make money on the short side when other people are long, things of that nature.
Yes, you are correct, Michael. Generally speaking, yes, people are long the market. People are long assets. So the short sellers, the short side, they're the minority. So, for example, in general conversations, people say, "Oh, the markets are going up. You must be doing well," because everybody assumes you're long, right? Because that's the natural state of the market. There are more people invested in the markets than there are people who are betting against it. Yeah, you're right. So it's there's no rational justification for it, but there could very well be a human emotional sort of
So
Well,
so tell me this. This is a interesting question here. Tesla, you mentioned it before, and it's obviously the talk of the town, talk of the world right now. If you're talking to Elon Musk, you're sitting in the conference room with him right now. What do you tell him? You know, it seems like he's the sort of guy, he just tweets randomly. He doesn't care what anybody says. He's got a board, different things like that. He just does his own thing. What do you talk to a guy like Elon Musk about?
first of all, I don't have a position in Tesla. Okay, so with that disclaimer, but I would say this: he may have just gone a bit too far for his own good, because if he does not have committed funding for what he tweeted, he could be in a lot of trouble with the regulators, because this could be viewed as huge market manipulation of the stock price. So he may be out of a job. So
No,
that's what I would tell him.
well, that I tend to agree with what you're saying on that. But that's what I'm saying more on the mental side. What would you tell him about what you're talking to us about edge and process and things of that nature? Obviously, he's got a number of different companies, and he's not necessarily trading the market like this. But I'm just wondering on a mental side, what would you talk to him about?
I would tell him that he needs to transition from having his personality has done very well, it's worked very well for Tesla and Tesla stock. Okay, his personality so far has done very well. But what got him thus far is not likely to get him further. So he needs to make a shift. And the shift would be to a more mature, more serene, more conventional CEO, where let the results of the company and the products of the company focus on that, let that speak for itself, as opposed to the halo effect that has worked very well so far. The Elon Musk halo, the great entrepreneur, the visionary, the big fan club that he has, that's worked very well for him and his company so far. But going forward, he probably needs to shift gears into becoming more mature, more stable, and let the company's results and the company's products speak for themselves. That's what I would tell.
Yeah, that makes sense. One other point I was going to mention. What about social media? When you talk to people and the effect of social media on one's mindset, always, whether it be when you tweet something, when you type something, the rest of the world can see it and judge you and comment. How do you talk to people about, in a way, not worrying about what the world thinks? You're just expressing yourself, things of that nature.
Great question, Michael. I'm not sure if I'm fully equipped to analyze the effects of social media utilization and how best to conduct ourselves there. But the fact is, it's an overwhelming phenomenon. It's impacting our personal and professional lives. It's impacting our performance. A tweet here can directly impact our portfolio, our positions. A tweet there can directly impact our portfolio and positions. So this is, social media today is the new Reuters, Telerate, and Bloomberg News of the day today. That's where we're getting all our market news.
Yeah,
Whether
exactly.
it's cryptocurrencies or whether it's Tesla or whether it's any other breaking news. So it's part and parcel of the world that we live in. Just look around you. You sit in a room, or you sit on a plane, or you sit at an airport, or you're walking down the street. Everybody is looking at their phones. Everybody's glued to their phones, right?
Absolutely.
While people are walking, they're texting, they're talking, or they're going scrolling through the phones. It's a whole new phenomenon. So just accept it and adapt.
That makes sense. I have one question coming in from Bryn. She's asking, has Rajan found that... Hang on one second. Has Rajan found that holding period has any influence on edge or perceived edge? As in the example you gave earlier about the trader that did his research, put on the position, and then took a week off to avoid the noise, versus if anyone had to get flat at the end of every day.
It really varies from trader to trader. That's about trader styles. Each trader has a natural state, natural style that they're very comfortable with. And part of knowing what your edge is, to be comfortable with a trading strategy and a process that is natural to us. For example, I have never been a good day trader or a short-term trader, and never will be, because that's not my natural state. I cannot trade the minute-to-minute movements or the hour-to-hour movements. I am more a structured, longer-term horizon trader, or at least I was. So for my horizon was, 3 to 6 months. I put on structured trades with the anticipation of certain price movements in a 3-month period. That trader's example that I gave, his horizon was 5 days. There are other traders who are, momentum traders who want to go flat at the end of the day by mandate or by choice. They'll do hundreds of trades during the day, but that's their natural state. Whatever fits the style. Each trader has a different style, and the time horizons are different by definition. As to how they view risk, how they take risk, how they structure the trades, how they manage their risk, and what they're looking for. So I hope that answers your question. But I would highly recommend identify what your natural style is, your natural state is, and shape your whole investment process and discipline around that natural state so that we feel comfortable.
Right. Okay. Well, I think you gave a lot of great information talking about edge, process, and like you said, I'd like to get more into process, and as well for a combination, whether it be a beginner trader or experienced trader. I think that's important as well. But you gave a lot of great information. I appreciate you taking the time, and we look forward to speaking with you. I think pretty much every week we're going to be speaking with you. Hopefully next Friday as well we'll be speaking with you.
Yes. Okay, and hopefully by next Friday we'll get more into the investment process and how to develop one. Okay?
That would be great. Look forward to it.
All right.
Thanks for taking the time, Rajan.
Thank you so much, and thanks to all the participants.
Okay.